Hey guys, we got a great one today, man. Don't forget to go to the description box, man. We got some great treats for you. Thank you.
Beginner Forex training course. In this course, you'll learn everything you need to know to begin your journey as a Forex trader. The first question we're going to ask is the most simple question possible, which is, what is Forex? So, Forex is actually the largest market in the world. And what does that mean? How big do you have to be the largest market in the world? Well, on an average trading day, the Forex market trades 5 trillion with a T dollars. That is a large amount of movement for one trading day. $5 trillion, that's insane. So that's why the Forex market is the largest market in the world. Now, another thing you need to realize about the Forex market, and the second thing we're going to go over, is that in the Forex market, what you're trading is called a currency pair. A currency pair is nothing more than the exchange rate between two currencies. We've all had to exchange money before, if you've traveled at least. Maybe you haven't, but if you've traveled outside of the country you live in, you've probably exchanged money for another currency. For instance, if you live in the United States and you take a trip to Europe, then you more than likely will exchange some of your US dollars for European dollars. And that rate, the rate of exchange, is what you'll get back. For instance, right now, the euro-dollar exchange rate is 1.0878. So let's just write this down. The euro against the dollar right now, or the euro-dollar exchange rate, is 1.0878. So that means that if you were to go to Europe right now and you wanted to get, because right now 1 euro is worth $1.0878. Now, the way we make money in the Forex market, remember we're trading based on the exchange rate between two different currencies, and the way you actually make money is when this exchange rate rises and falls. So these exchange rates fluctuate depending on the strength and valuation of each of these currencies, the euro and the dollar. So if the euro rises in value, then it's going to take more dollars for you to get 1 euro. The same thing if the dollar, so let's say the euro goes up in value, let's just start here. The euro goes up in value, then you're going to need more than $1.0878 to get 1 euro. And if the dollar goes down in value, it's the same thing. And the opposite is true if the opposite happens. If the euro drops, then you're going to need less dollars in order to get 1 euro. And if the dollar rises in value, then you're going to need less dollars to get 1 euro. So let's do an example of that right now. What you're actually making money on in the Forex market and what you're trading based on is this exchange rate fluctuating in value, going up and going down. So if this exchange rate goes from 1.0878, let's say you put in a buy order. We're going to go over all of this later on, so don't get confused yet. But if you put in a buy order at 1.0878 and this exchange rate goes to 1.0978, then you make the difference. You make the profit of essentially 1 cent, but we are trading based on huge amounts of size in the Forex market and with leverage, which we're going to discuss later on. Right now, what you need to understand after the question of what is Forex is what is a currency pair. And that's what we're going to break into right now. Now that you know what the Forex market is and kind of how it works, let's break into breaking down a currency pair and give you a complete understanding of what a currency pair is. Let's do that right now. A currency pair, if you look on the chart in front of you, is what you see to the far right edge. I will actually make this a little bit bigger so you can see it. As you can see on the side here, we have euro versus dollar, pound versus dollar, dollar versus yen, Aussie versus dollar, and dollar versus Swiss. Those are the major currency pairs, the top 5 major currency pairs. Now, with that being the case, each of these is made up of separate currencies, right? So the first thing you need to understand is what each 3-letter symbol represents which currency. So for each 3-letter symbol we have, that represents a certain currency, and I'll post a screenshot of which currencies are represented by which 3-letter symbol right now. You'll see that on the screen. So with that being the case, we have one currency's value against another currency's value, which is what gives us a better interpretation of the value of a specific currency. So in the case of the euro dollar, let's say. This is a currency pair that we can trade. It's actually the most popular currency pair in the Forex market. And the euro dollar, if we write it out here, consists of two currencies, right? These two currencies are called the base currency and the quote currency. Now, don't let this sound too confusing. There's nothing confusing about a currency pair. The only thing you need to know about a currency pair is that currently the euro dollar has a value of 1.0792. So the fact that the euro dollar has a value of 1.0792 is important because you need to understand that that is the quote pair valuation. So what that means is every base pair, as in the first pair, and this being the second pair, every first pair in a currency pair always has a value equal to 1. You are always exchanging one of that first pair for whatever the quote pair is. The quote pair is the actual quote you see on the screen is your quote pair. So you're getting 1 euro. What this means in hindsight is that if I have 1 euro, I essentially have $1.07.92. Or another way to look at this is it takes $1.0792 to make 1 euro. So therefore the value of the euro is higher than the value of the dollar by roughly 8 cents, 792 cents. So let's look at one more pair and try to go over this one more time to make sure that you're getting it. And I'll ask you some questions while I do this to help you to better learn, because asking questions and having you answer them is a much better way for you to learn than for me to just write shit down, right? So let's do that. Let's go for the dollar yen right now, okay? So the USD / JPY is the dollar yen. With the dollar yen, which one of these pairs is a base pair? Is it the dollar or the yen? Hopefully you said the dollar, right? Because the first pair, the dollar is the first pair in the equation. The yen would be the second pair in the currency pair. So with the dollar being the first pair, that means it is the base currency of this currency pair. With it being the base currency of this pair, what's its value always equal to? 1. When you're looking at the valuation of a currency, this value is always going to be equal to 1. The JPY is what? It's called the quote pair. So if it's the quote pair, then that means whatever the value of the dollar yen is, and it's on the screen now, it's 110.90. So if the yen, let's say the dollar yen itself is 110.90. So it takes $1 to have, if you have $1, essentially, that means you have 110.90 yen, excuse me, not euros, yen. So at this point, we can see that $1 is equal to 110.90 euros, or if you have 110.90 yen, not euros, I keep doing that. If you have 110.90 yen, then you essentially have $1 and vice versa. So this is a currency pair, and this is how you're always going to look at it. The first pair is always the base pair with a value of 1. The quote pair is what you're seeing as a quote. That's what the value of the second currency is compared to the first currency. The quote pair is always the value compared to the first currency. The first currency is always the currency being compared to, and it always equals 1. So in this case, again, the dollar would be 1. The yen means I need $1, and when I have $1, I essentially have 110.90 yen. So that was a look at what Forex is itself, and also what is a currency pair, in case you were struggling with that or didn't know, or essentially in case you were coming into the market. A trading course is, what is a pip? We have to understand what a pip is, because a pip is how the Forex market moves. A pip is the smallest amount of movement we can see in a currency pair that actually matters to us whenever we're placing orders. A pip is how we make profit or get stopped out depending on how our trade goes. So it's very important that we understand what this is. Again, a pip is the smallest number that moves in a currency that we care about as traders. There's one number below this called a fractional pip that we're not even going to talk about, other than me saying don't pay attention to it because it does not matter at all to us as traders. So what is a pip? We know that a pip is the smallest number that moves in a currency pair But how do we identify a pip? Well, look at the euro dollar right now. Right now, you can see that the euro dollar last price is 107.87, 1.0787. So let's write that down. We have the euro dollar at a price of 107.87, 1.0787. And you can see on that currency as well that there is a smaller number as a fifth decimal, a smaller number that's 2 right now in red. That's a fractional pip. We're not going to worry about those at all. What you need to understand is that the way you identify a pip is the 4th place away from the decimal. So the 4th decimal point, meaning if this is the decimal point, we count over 1, 2, 3, 4. This is a pip. And let me clarify that really quickly. Right now, we are talking about a pip on every currency pair except currency pairs that end in JPY. Any currency pair with JPY in it is going to be slightly different than this, and we're going to go over that next. So this is going to be what is a pip, and I'm going to put non-JPY here so that no one's confused. This is a pip on every currency pair. For every currency pair that doesn't have JPY in it, the 4th decimal place is what is known as 1 pip. So we have the euro dollar at a value of 1.0787. What if the euro dollar goes to 1.0786? How much have we dropped? The euro dollars went down now, but by how much? Well, the math here is pretty easy. If we went from 7 to 6 on our 4th decimal, which is a pip, we dropped by 1 pip. And here's how I want you to look at this. This is the way I looked at it at the beginning, and it really helped me to understand this a little more clearly. Not that it's a super complicated thing. Understanding this, if you watch this video a couple times, will be extremely easy. But the way I look at this is, let's write out our value of the euro dollar and space it out a little bit to give us a little bit of room. And that's what I'm really trying to do here. I want to give myself a little bit of room. So we have 1 decimal 0.787, right? So with this being the case, the way I look at this, if I count my numbers, 1, 2, 3, 4th decimal place is a pip, I like to look at it like this. This is our 1s, meaning every time this moves, it's going to be 1. This is our 10s. Every time an 8 goes up or down, in this specific case, that's going to be 10s. And this is our 100s. That makes it so easy to say, okay, if the euro dollar went from 1.0787, what it's at right now, to 1.0797, how much did we move? Well, let's look down here at our chart where that's the 10s. That column is the 10s. That decimal point, number 3, is the 10s. So therefore, this went down. And actually, in this case, since we went up from 8 to 9, hopefully you caught that before I did, then obviously that means that the euro dollar went up 10 pips because it was in our 3rd decimal point. Now, let's do one more number to make sure you understand this, and we'll go through one more currency pair to really make sure you have a good grasp on this. This is the foundation of any trading career. So let's do 1.0887. Can you tell me, at this point, how many pips did the euro dollar rise? Well, let's look at our column or graph. We have our 1s, the 7, it stayed the same. We have our 10s, which was 8, it stayed the same. We have our 100s that was 7 and is now 8. That means that the euro dollar went up not by 10, but by 100 pips. So that's the way you recognize a pip. A pip is the 4th decimal place. It's the smallest amount of currency moves that we care about as traders. Let's do a completely different currency pair that is not a yen pair and go over one more. And again, just like in the last lesson, I'm going to ask you a lot of questions as we go through this. I'm going to ask you a lot of questions as we go through this, and I want you to actually answer those questions on the other end where you're sitting or standing, depending on whether or not you're trying to get exercise in. And now what we're going to do, again, is go over a different currency pair. Let's go over the Aussie New Zealand. Let's just pick a random pair. So AUD, NZD. I do my N's backwards. I'm slightly dyslexic. I literally just drew an N backwards because I cannot ever remember which way they go, and in my head it's always backwards. So we have the Aussie New Zealand, right? The Aussie New Zealand has a current value of 1.0248. 1.0248. Tell me what would be the case, Okay, let's go over a scenario. If the Aussie New Zealand went from 1.0248 to 1.0348, how many pips did this currency pair move? I'll give you a second. Hopefully you were able to say 100.